Welcome to LaTour Retirement Talk. I'm your co-host, Tony Shore, and I'm here with our hosts, Jim Margraf and Josh LaTour. Jim and Josh, great to see you guys again. Thanks for having me on the show. I know you have a big one. This is going to be a great show, talking about your retirement calendar, the different key ages, what needs to be done. This is always a great topic. We always get a lot of calls and questions on this. So I'm anxious to dig into it. But first, as always, we have to check in. Jim Margraf, I'm almost afraid to ask, but what did you do this past weekend?
Well, Tony, I had a little bit of fun with some friends and neighbors. Ate some nice brisket yesterday. Oh, yeah. Mm-hmm. And also watched my remote control lawnmower mow my yard for me. So, yeah.
It's like one of those.
I have a Roomba for my yard.
It's like a Roomba, but for your yard.
Yes, sir.
Because that thing doesn't really work, does it?
Every day.
Every day. Wow.
Every day. Yeah.
Wow.
It does like so much of the yard at a time, and then goes back to the charger, and then goes on to the next portion.
Does it go back to the charger on its own?
Mm-hmm. Unless it's falls in the ditch or gets caught on some tree branches that fell down, something like that. But yes.
Huh. Now, Jim, did I ask you to tell us you're lazy without really telling us you're lazy?
Hey,
I'm kidding. I'm jelly over here. I'm
jealous.
Just jealous. Yeah, I'm just jealous.
Yeah.
So unlike Jim, I actually mowed my yard this last weekend.
I had to use a weed whacker, though.
Yeah, same. We mowed our yard. Actually, my wife did most of it because I've been building a deck, and I built the floor of the deck. It was just going to be a catio, but I went for it on the floor, and I didn't realize I had it in me. But I'm doing this thing right, so we're going to be able to go in there, and it's going to be like a screened-in porch. But also, we'll be able to crank open the window on the back of our house, and then the cats can come in and out if they want. And
catio. Okay. I was
a patio, an outdoor patio for cats. So it's screened in, called a catio. Yeah. We have a dog too, not to offend our dog people. We have a dog. We love our dog. His name is Enzo, but we also have 4 cats, and we'd have more if it's hard. Yeah. Poor me. I have a wife and 2 daughters and a son, but the wife and 2 daughters, if I let them, we would be raising chickens. We would probably have other animals, and we'd have 20 cats and at least 3 dogs. But I've limited them to 1 dog and 4 cats. And I did limit them to 1 dog and 3 cats. And you see how well that went over.
Right? Yes.
It
went well.
Yeah, we're up to 4 already. I don't know how that. Actually, it was 1 dog, 2 cats for a long time. That's where I drew the line. I said, this is fine. And now we have 1 dog and 4 cats, and I've ixnayed a new dog. I put the kibosh on another second dog for a while, but we'll see how long I can hold them out. How about you, Josh? How have you been?
I've been good, Tony. Yeah,
good.
We this last week we were in Florida for a few days.
Oh, fun!
Just kind of spent some time with the family. It was funny because we had coinciding, basically short vacations.
Right.
We did with Jim and Lisa. And they were staying, like 30 minutes away from us?
Yes.
Never saw them, but
you guys were out there too?
We were in Florida as well. And, my wife actually was the one who booked it, and I wasn't paying much attention. Well, yeah, Josh and Courtney. Oh, wait, Josh and Courtney are going to Florida too.
How far away? You were different parts of the state, though.
Just 30 miles away.
Yeah.
Oh, wow. Where did you go, Josh?
We were kind of in the 30A area near Rosemary Beach. And they were in Panama City Beach.
Oh, okay. I see.
Yeah.
I see. So up on the Panhandle.
Yes.
Yep. Yeah.
Mm-hmm.
Yeah. Friends of mine just got a condo that they own now in Destin.
Oh, nice.
They offered it to us to use anytime we wanted. So, or when it's available. So,
well, any friends of yours is a friend of mine. So
yeah, said it before. Say it again.
There you go.
Yeah. Well, that's great. I knew you were in Florida, Jim, because I knew Jim was there because popped up on my feed this morning over the weekend, Florida man set up a tiki bar in the Walmart parking lot and was selling drinks to customers in the Walmart parking lot. And he did that for 3 hours until the police finally showed up. And I'm like, Jim must be in Florida. Those Florida man news stories are get crazier all the time.
They are funny
all the time.
Where we stayed was actually interesting because of the fact that as soon as we left the resort, if we headed east at all, we switched time zones. So we were right at the time zone line in Florida.
So there's more than one time zone in Florida.
In the Panhandle, yes, it switches, and we were just like, I don't know, 2 miles away.
Jeepers.
So you'd be looking at your phone. Yeah, I got to be there. I'll be there in 15 minutes. And you look at your phone. Wait, it's an hour. What happened?
Yeah.
Oh, it's so confusing.
Because your phone and watches, like if you have an iPhone or an iWatch or a smartphone, it switches times. Yeah.
It does.
That is hilarious. Well, hey, let's talk about your retirement calendar. I have to see. I'm creeping up on this list of, we've went over this a couple of years ago. We went over this, and I think it's time to revisit it because it gets a great response. But I know that I've bumped up on the calendar a little bit in the last couple of years.
Getting a little inching closer.
Yeah.
Yeah. Well, that's the thing, Tony. I mean, you hear all these things that you should be thinking about for retirement, and it's hard to know, like, what should I be doing, and then when should I actually be doing it? And so we put together this retirement calendar to kind of help give you a bit of a roadmap when it comes to completing the things that you need for retirement. When should you be thinking about it? So we're just going to kind of breeze through the different ages on our calendar and kind of give some ideas for each of those ages.
Yeah. Yeah. And that's interesting because I know that a lot of people think, well, I don't need to think about retirement until I'm 60 or 62. Right?
Yeah.
Wrong.
Wrong. Okay.
People think that, but that's not the best time to start thinking about it because really retirement planning starts when you start. So as soon as you start working, take advantage of that 401k, start putting money aside, even if it's just a little bit, start putting money aside. Your future self will thank you so much for doing so. So item number 1 on the list is as soon as you start having a consistent income, put some money aside.
That's when saving for retirement starts.
Yes.
The earlier, the better. And it's never too early to start.
Correct.
And it's never too late to start if you didn't. It's like planting a tree. The best time to do it's 20 years ago, but the second best time is
now.
Today. Yeah.
Yep.
Right now.
Yep. Yeah, exactly. And I like how you mentioned, Jim. It's not necessarily about setting aside giant amounts of money when you're starting out.
Right.
It's about forming the habits that are going to set you up for success. By setting aside a portion of your paycheck is going to set you up for success in retirement. And the earlier you can start that, the better, because it takes time for a habit to form. And,
sure it does.
And if you spend time doing the wrong things, you're going to form the wrong habits. So. Setting things aside, utilizing the 401k. If you don't have that option at work, utilizing IRAs, Roth IRAs, and working with a financial professional that can help you along the way.
Absolutely. We get people that come in and say, well, I'm not quite ready to retire yet, but so I don't know if I should be sitting down with a financial advisor and thinking about what to do next. And, I say, absolutely, sit down. We don't need to have the multi-appointment hour-long, process. We can, here's the things. Are we developing the habits? Here's the things we need to do. Start saving, get your debt paid off, things like that, and go from there. I would say the next thing is pay attention to who the beneficiaries are on your retirement assets. Well, all of your assets, really. Do you have an estate plan, or as we'll call it, enhanced planning? Do you have that set up? Make sure those beneficiary forms are in place, because you don't want the government's plan for your assets. You want to have your plan.
Right. I think that's really important. Obviously, you want to have a plan in place, and especially once you're married and start a family, you want to have that estate plan done.
Right.
And estate planning isn't just for the wealthy.
Nope.
It helps. The more you have, the better, but it's for your family. If you love your family, you're going to plan, right?
Yes, you will.
Exactly, Tony. So why don't we kind of dive into the first official age on our retirement calendar?
Sure.
And that's going to be 50. So in 2026, the maximum amount for the contribution limit for an IRA or Roth IRA is $7,500. But at 50, you get a little step up. You get to add a bit extra to that. So you can actually put an extra 1,000 into that IRA and Roth IRA. And then into your 401k, it's even better. The maximum amount is $24,500 for 2026. But at 50, you get an $8,000 catch up. Now that does have to be contributed to Roth. So that's one of the rules that they've recently added in for the catch up in 401ks. But, if you've gotten behind a bit in setting things aside for retirement, 50 gives you that opportunity to start things kind of moving quicker. And so having those catch up contributions is absolutely huge for someone who, maybe started a little late.
Yeah. Yeah. And that's good. I mean, that's where, unfortunately, I didn't get really hardcore serious about retirement until probably late 40s, and then 50 really kicked it down. And, that's why I told my kids when they were 21, my daughter opened a Roth. She puts $200 a month in there. But had I done that, hindsight's 2020.
Oh, yeah.
Had I done that starting when I was 21 and had my first full-time job, by the time I'm 65, I'd be a multimillionaire. I mean, that's just the numbers. That's the way it works. If you have good growth. And, I think that's so important to plan ahead. But once you're 50, you got to kick it down. You can start playing catch up, right?
Yeah, exactly. And we've talked about it on the show before. We've talked about Trump accounts a couple shows back.
Oh, yeah.
Where, starting your kid out can actually set them aside with a large sum of money by retirement because of the compound interest over time.
Right.
It's amazing what it can do. But if you didn't have that, that luxury from your folks, then once you get to 50, you get those extra catch-up contributions you can do.
Sure. And it's not even about one-time contributions. What's even better is just consistent, regular contributions. The earlier you start those, the better. And as you get older, increase the amounts. I mean, it's always great if a parent or grandparent or Trump puts a lump sum in there for you. You know what I mean?
Yeah. We'll take it.
I'll take that. If the government wants to give my kid money and let it grow over time, awesome. But you really need to make sure that you know what you're doing and it's the right type of account for you, especially when you get into age 50 and up, right?
Tony, that is really important because so many times we stop and think that, hey, we'll just go to the traditional advice and put it into the pre-tax accounts, but maybe you ought to be putting it into a Roth. And that's just something that everyone should evaluate. We always tell people there's no one thing that's right for everybody, but this is something you definitely need to evaluate and see if it's right for you. Personally, I'm in favor of the Roth. It's what I do for me. So it's got some massive benefits.
Yeah. Yeah. And I mean, there are limits to what you can contribute, but I know at age 50, there's that $8,000 catch up. Right.
Yep.
But that has to be into a Roth, the catch up, right? And
that's correct. In your 401k. That's right.
Into a 401k if you're doing that. Okay, so that's 50.
Right.
I think we covered that. What about 55? Is there anything at 55?
There is.
Yep.
Because that's the age I tell people I still am, even though I'm 60. So I am curious what I can do now that I'm 55.
So at 55, if you have done well and set money aside, or you're changing jobs and you have money in a 401k, and you're no longer working for that company that sponsored that 401k, you can take funds out of that 401k with penalty free.
Right.
Now, notice I didn't say tax free, but you can take it out pre-59.5 without that extra 10% penalty. It's only on those workplace retirement accounts. It's not on your IRA. So if you roll the funds out to an IRA, the rule of 55 goes away. It's only on the workplace plans.
Yep. And it's only if you separate from the company, right?
Yes, you cannot be working for that company.
So if you leave a company and you had a 401k there, and you're 55, you can take that money out of your 401k that was at the company that you left.
Right.
However, you're going to have to pay full taxes on that,
Yes,
and it could bump you up into a higher tax bracket. So don't even do that without consulting with a trusted financial professional, right?
Yeah, absolutely, Tony. That's the thing. And a lot of times people will utilize that rule to be able to retire a little bit earlier, or maybe semi-retire at at 55 to 59 and a half. And so they can have income coming out. So they're not taking a whole lump sum at once, but they're just taking monthly income from that 401k and helping them sustain their standard of living until they reach 59 and a half.
Yeah, in case they want to retire early or able. So that's good to know, the rule of 55. Now the big one though, this is one of the big ones. There's a few in here. Age 59 and a half. What does that, you just mentioned it. What does that mean?
Well, Tony, 59 and a half, like you said, it's such an important age. That is the age at which you can access your retirement accounts penalty-free. Again, like Jim mentioned, not tax-free, but the 10% early withdrawal penalty from your retirement accounts goes away at 59 and a half. And so now you can start pulling from these funds. The other thing you can do is at least at the vast majority of employers, you can roll your retirement account out into an IRA at 59 and a half. And why would you do that? Well, a lot of people, the 401k is fantastic for what it does. It helps you set aside money before you ever see it. And it does a great job of that. If it provides a match, it gives you extra funds into your retirement with that. But a lot of people don't get a whole lot of help with their 401k. And you're given a list of options to choose from, but you don't get a lot of management. You don't get a lot of direction. And so
it's
maybe
not
you're wanting
true
to
active management based on your situation,
Right.
like other funds are, like the G50 through Gradient, or, you guys can't get on the phone. Most people can't. You can put your clients on the phone. If they have an IRA and you help them set it up, you can call the fund manager, right?
Yes,
the portfolio manager directly, or the president of the investment company. If you want to do it, put them on the phone, speakerphone with your client. If you wanted to, you're not going to get that kind of service with a general 401k. And I remember one of my first jobs, guess how many options there were for 401k? Guess what kind of control they gave you? 3 options. You clicked one of the 3. And I don't even think this is legal anymore. I think they have to have more, but it was high, medium, and low risk.
That was it?
Wow.
That was it.
Wow.
It makes it simple, but
it was real easy. That was a while back. Let's just put it that way.
Yeah.
But it's still, at the same time, they haven't improved a lot. I mean, now they might have 4 or 5, and then within there you can go customize it, and that's how they get around it. But they try to simplify it for people, which I get, especially younger people who are new to this. And so, but there's a lot less control, right? I mean, it's funny because a mutual friend, I probably told you guys this, but our mutual friend, Foley, on my 59 and a half birthday, on the day I turned 59 and a half, and not that I was keeping a track. I didn't realize
you had no idea.
I had no idea, but I get a phone call. Hey, it's your buddy, Jeff. Happy 59 and a half birthday. And I go, what are you talking about? And he goes, as of today, you're 59 and a half. And I go, great. And he goes, you know what that means? And I go, let's see, I can access my 401k without penalty. Exactly. How'd you like to roll that into an IRA? That's a little aggressive, but still, it makes sense, right? I laughed pretty hard. Yeah,
that's great.
Yeah. So that was interesting, but that is a big age. You don't want to take your money out before 59 and a half because there's a 10% penalty on top of the taxes, right?
Right. Yeah, we want to stay away from those extra penalties. So 59 and a half, those pre-tax funds all are available for us to move, get them out into those IRAs, and get them under an investment that we can sit down with a financial advisor that's a fiduciary and get an investment that is suited perfectly for us, for our goals and objectives.
Sure. Now, how about my age? I just turned 60 this year. I'm ashamed to admit, but I did. And I know this isn't a big one, so we won't spend much time on it. 60 isn't a typical retirement year that you hear about a lot. Is there anything at age 60 I need to be aware of?
Well, you actually have a niche ability at age 60. From age 60 to 63, Tony, you can actually contribute even more into your 401k.
Right.
So you better get going on it. But
you guys are going to have to pay me more to co-host if I'm going to make any more this catch-up contribution.
I have to pay you at all to co-host.
It's the love. I'm doing it for the love of the game. You know that.
But no, so the regular catch-up is that $8,000 catch-up, but you get an extra $3,750 to tack on top of that. So you can put a nice, decent chunk away into your 401k. And it's kind of honestly, it's a weird rule.
It is.
For 4 years, you can put extra money away. So 4 more years, Tony, an extra $3,750 can go into your 401k.
Yeah,
there you go. There's your age 60.
There's my age 60. Well, let's move on to a bigger one. And this is
a big one.
This is probably the biggest so far, up there with age 59 and a half. But 62, what about 62? I hear that number a lot.
Yeah. Age 62, you are eligible for Social Security. Now, you are filing early. So unless you're on disability, this is when you can start filing for Social Security. Now, you do have to be age 62 for a full month in order to do this. Yes. But you are filing, this is way before your full retirement age. So you are in what we call the penalty stage of Social Security.
A reduced benefits.
It is a reduced benefit. So if your full retirement age is 67, you're going to get a 30% reduction in your Social Security if you're filing at age 62. But if, like when we do our workshop, this is actually Josh's portion of the workshop, and he says, hey, if you're age 62 and you say, listen, I don't have a lot of other savings or income, but I hate my job, you're going to need to file for Social Security and get that income coming in. But this is when you're eligible to start.
Yep. Yeah, and everybody's time when is best for them to file is different. And I know the majority, the Social Security SSA.gov site says the majority of Americans file at 62. That's the largest percentage wise that file at 62, which is a reduced benefit, which for a lot of people isn't the right age, but they're doing it because their neighbor did it, or their dad did that, or their brother-in-law, or a buddy at work and told them, oh, you got to file, you get more checks. But that's not, you don't always get more money that way. Sometimes it does make sense. If you get laid off and can't get another job, and you need the monthly income, or you have a health issue and you can't work any longer, you're going to probably, if you don't have enough saved up in an IRA to live on each month, you might have to file early, right?
Yeah, well, absolutely, Tony. Like we're saying here, there's no one size fits all when it comes to filing for Social Security. That's the earliest time you can. And like you said, a lot of people end up filing at 62. Some of them should, and many of them should not, because it's just not the right thing for them, but they didn't understand the rules. And that's why we actually teach on Social Security, is because we want to help our clients understand these rules so they don't make those costly mistakes.
Yeah, I know you guys do workshops, educational workshops and things. You've talked about it on the show, so I encourage our listeners to call you on that. What's the next stage?
Next stage is 65. And this is another big one. Not so much a financial one, but a health insurance one. It's Medicare age. So,
yes.
3 months before you turn 65, assuming you don't have, qualifying coverage through work. If you've got a group plan where you have more than 20 employees in the workplace, then you don't have to go on a Medicare Part B. But if that's not the case, then you're going to want to sign up for Medicare Part B. Otherwise, there are penalties that apply if you delay beyond age 65. And regardless of if you have workplace coverage, you still want to sign up for Part A, because that's your hospitalization. So you want to go ahead and get the ball rolling on Medicare Part A.
Right. Yeah. And you want to work with, there are trusted Medicare agents and specialists out there. And I know we've had, you in your office, you have a Medicare specialist, and we've had them on the show, right?
Yes, we have. Yeah. Kayla's been on the show a number of times.
Yeah. Yeah, I think that's fantastic. Well, that's a big one, age 65. A lot of people think that is full retirement age. It used to be, but it's actually when you're eligible for Medicare. And like you said, it's a good idea to sign up anyway when you turn 65, at least for Part A.
Yes.
What about, I know the next age on the calendar would be 67 probably, right?
Right. 67 is for now is for most people their full retirement age with Social Security. So if you're born in 1960 or later, age 67 is when you reach the full retirement age. So if you're going to file for Social Security while still working, the annual earnings test no longer applies. You're no longer in what we call the penalty stage of Social Security. You're going to get your full benefit. So it a lot of times makes sense for people to start now. Like, for instance, we had some people that they're looking to pay off an extra debt while they are a little bit left while they're working for another 6 months or something like that. They'll go ahead and file, have their work income plus Social Security, and they'll use their Social Security check for a few months to go ahead and help get that debt finished, paid off, and then when they retire, they're debt free and they're off and running into retirement. So
nice. Yeah, that's a great idea. And full retirement age, I mean, tentatively, I'm smart enough to know. I'm kind of thinking about that for myself. I've had the Social Security maximization report run, and I want to work at least until then, as long as my voice holds out. I've said that, so that's good. But yeah, that's full retirement age where you receive your full benefit. But then as something happens, age 70 is an important age to remember because that's something else with Social Security, right?
Yeah, that's the final important age for Social Security.
Right.
If you decide to wait until 70 to take that benefit, for every year beyond your full retirement age, we were talking about 67, for every year beyond that you delay filing for your benefit, you'll receive 8% simple interest and delayed retirement credits. So if your full retirement age is 67, at 70, you get 124% of that benefit. So a nice, decent bonus on top of what you were going to receive.
Wow. That is huge.
Yes.
That is huge. So that's good. And then there's also 70 and a half for QCDs. Is that right?
That is correct. It is. So if you are charitably minded and you have those pre-tax accounts, now is the time, instead of waiting till later. If you especially if you think, hey, I don't need all this, instead of giving to those charities from your bank account, give it from those pre-tax accounts. You don't have to pay taxes on those funds, and neither do the charity. So it's a great way to go ahead and give the amount that you'd like to, but in a tax efficient manner.
All right. And let's add one more age as bonus content for our viewers, for our YouTube viewers out there. They get a little extra bonus in the show because we have one more age to talk about, and that's age 73, right? That's our final age on the retirement calendar. What happens at 73?
73 is an important one. That is required minimum age distribution. So at that point, you've got to take distributions from your pre-tax accounts. Basically, IRS has said, we let you go ahead and delay taking taxes all the way till 73. Now we want you to start pulling from these funds and pay taxes on it. And so 73 now. In 2033, that's going to change to 75 for people who were born in 1960 and later.
Right.
So that's another important thing. So actually, it's two ages. We got 73 and 75 for those born in 1960 or later.
Right. So on this one, so between 59 and a half and 73, or in a few years, it'll be 75, on those pre-tax accounts, we have a choice as to whether or not we want to take funds out of those. But when we get to that retirement, that full RMD age, now we have to.
Right.
So
yeah, they make you take the required minimum distribution, which is a percentage of what you have in your traditional accounts.
Yes.
And they make you start taking it out and pay full taxes on that. And you have to be careful because that could bump you up into a higher tax bracket, right?
Absolutely could.
It very much can.
Yeah. So I know that sometimes you have strategies to minimize that tax burden in retirement, and you've talked about them before. Roths. There's cash value life insurance. There's things you can put in a tax-free bucket and maybe pay gradually over time, or now when taxes are lower, gradually convert some of that money so you don't have to pay taxes later when the tax rate will probably be higher. I would assume it would have to be.
Yeah, because the thing is, Tony, we can't get away from paying taxes. we are going to have to pay the piper. We have these pre-tax accounts.
Sure.
You're going to have to pay them, but you can choose when. And so by utilizing some of those tax-free buckets, whether it be via Roth conversion, life insurance, like you mentioned, there are a number of different ways to do it. But setting yourself up to where you're not paying exorbitant taxes in your later years via those RMDs.
Sure. Well, it's been a great discussion. We covered the retirement calendar, a lot of ages in there. Before we go, let our listeners know how they can get a hold of you to set up that no charge, no obligation consultation to get a plan in place or to ask questions.
Absolutely, Tony. Listeners, you just need to give us a call. Our number is 417-641-3497. And our website is LaTourAsset.com.
All right. Thanks so much. And listeners and viewers, thanks for tuning in. That does it for today's episode of LaTour Retirement Talk with our hosts, Jim Margraf and Josh LaTour.